account. All right. Know the different investment vehicles. We're going to go a little bit into financial institutions, but not too deep. We're going to analyze some portfolios, some strategies, how to manage your own portfolio. Then we're going to get into some historical stuff, herd mentality, and then some major market events, so you don't panic sell, because that's what we all do sometimes. All right, these are the building blocks of any investment in terms of stocks, bonds, mutual funds, anything like that is going to be built by one of these, or all of them, or a combination thereof. So stock is just ownership in a publicly traded company. Hopefully you guys all knew this prior to last class. The watch is making noise. These are listed on an exchange. A brokerage firm gives you access to that exchange. That's why they're called a brokerage firm. They're a broker between you and the New York stock market, or whatever stock market your stock is listed on, so you don't have to physically go and buy the stock. Okay? Make it super easy. Bonds, this is a debt instrument where the company or government guarantees a principal plus interest. So think of this as you're lending Apple money to buy a car, and Apple is giving you their car note money. Okay, that's what it is. Apple issues bonds. They want to build a new facility. You buy those bonds. They guarantee 5% plus principal back. Sounds good, but it's over like 30 years. So people buy and sell these based on where they're at in terms of retirement. If you want 5% income and you want Apple bonds, then you just go out to whoever bought Apple bonds 10 years ago or whatever that were paying 5%, and you buy those, and those will fund your retirement. Okay, so hardly anybody keeps these to maturity except like big mutual funds. They'll keep these to maturity. Also, big mutual funds get the dibs on the best bonds. So I had a client come in, always wanted Cleveland Clinic bonds. It's one of the best hospitals in the country, and it was slim pickings because all the big mutual funds gobbled them up. Okay, bonds are a big part of a lot of portfolios. REITs, REITs are real estate investment trusts. Somebody gets together, they pool money together, they go invest in property, and they pay out a large portion of the rent they get to their investors. This is a way to access the real estate market without all the hassle of renters and everything that comes with the rental property. Okay? Last one we're going to go over is derivatives. Derivatives are basically options. There's more than options, but basically they're options. So this is a bet on top of a bet. And if you guys have ever seen those stock, some of those stock movies, like The Big Short, stuff like that, sometimes it'll talk about derivatives. These are like the mortgage bonds that everybody talks about that crashed the market in 2008. Those were derivatives. Um, Options are derivatives. So basically, options are a coupon. So let's say you have milk at the store, right? And you buy a coupon saying that you now have the option to buy that milk at $2. And let's say you paid like 10 cents for it. You now have a piece of paper. This piece of paper does not have anything to do with that price of the milk. It's just a piece of paper giving you the right to do something. Okay? It's not changing the price or affecting the price of the actual milk. Now you could walk in and you can say, "Hey, milk is trading at or milk is on sale for 2.50. My coupon says I can get it for $2. Give me some milk for $2." They have to honor it because they sold it to you. They sold you the coupon. Now, if milk goes down to 1.50, what's this coupon worth? Nothing. You just lost your 10 cents. Okay? That is what an option is in a nutshell. So you could do options on different stocks. And that's what's called a derivative. Okay? So all of your investments, whether it be ETFs, whether it be mutual funds, whatever are going to be made up of a combination of these. And very new to the mutual fund market, ETF markets, is stocks that are paired with derivatives, and you would not believe the return on some of these. But they're relatively new, so they're going to be a little on the risky side. We're going to go through some of those as well. All right, so let's look at some types of mutual funds. Okay, and the reason I'm going directly to mutual funds and not stocks is because this is curriculum for financial advisors. So I'm teaching you to be your own financial advisor. And the lower licenses can only sell mutual funds or annuities. They can't sell individual stocks and bonds. So we're progressing just like a financial advisor would. So Series 6 first, you can sell mutual funds. Then if you get your Series 7, you can sell derivatives and individual stocks and bonds. So we're going to cover mutual funds first. Again, these are you could have open-end funds, you could have closed-end funds, you could have ones that have like a duration. Closed-end funds and intervals are probably not the ones that you are familiar with. The normal mutual fund is going to be open-end funds, meaning that every time a purchase is made in that fund, new shares are issued. And that's going to be important moving forward. There's different asset classes. So if you go into mutual funds, we're going to go into a mutual fund screener on Charles Schwab and take a look at these. You can have equity funds that are all stocks. You could have bond funds. You could have money market funds, which are like savings accounts. You could have hybrid funds, which are a mix of the two. Hybrid funds are also what you have in TSP. Those are the L funds. L funds are hybrid type mutual funds. They move, they fluctuate their equity and debt and cash based on how close to the year that they are getting. So let's say you pick L2050. It's going to have a lot of equity, a lot of stock in it, a little bit of debt, and a little bit of cash. As we get closer to 2050, it's going to move more towards cash and more towards bonds. That's going to be a hybrid fund. Okay. You can also narrow it by investment objectives. So if you say I have a long-term goal, we went over goals last class. If you have a long-term goal, you want to pare down and look at growth funds, ones that are going to give you, going to grow over time. These are like your technology stocks. This is like Apple. This is like Tesla. Those are all looking for growth. They're all looking to go big and grow by like 20% a year. Okay. Fixed income funds. These are for income. Fixed income is they pay you on a monthly basis, on a quarterly basis. If you are interested in income, you would look at fixed income funds, compare the different ones, compare the risk versus the dividend, and we're going to do that today. Compare those and see which one's best for your lifestyle. Okay, a lot of people do these in retirement, but younger people have been looking at fixed income funds just because they're a consistent payment, regardless of what the stock is doing or regardless of what the bond is doing. So the way income and dividends works is, let's say I have Altria, which is the Marlboro Man. They'll pay, let's say it's $1 per share. That's huge, but anyways, let's say they pay $1 per share. Whether that share price is 100, which makes it 1%, or that share's $1 and they're paying you $1, that's 100%. Okay, so that dollar doesn't change unless the board actually goes in, votes to change it. Okay, so a lot of these dividend stocks are very consistent in terms of their payouts, and you could get some deals when the market has declined and you're still getting $1 for that depreciated stock. Okay. Tax savings funds, if you are a high tax bracket, there are funds directly their entire objective is to invest and save you on taxes. Okay. There's also pension funds. Um, we're not going to get into those a lot. Those are on the corporate side. You can get a personal pension. Those are annuities. Not a big fan, but I do know them inside and out. If anybody wants to talk annuities, there's also specialty funds. Okay, these are like maybe a specific sector. I only want to invest in financials. You're going to have your Bank of Americas. You're going to have your Charles Schwab's in there. You're going to have your T. Rowe Prices in there. Let's say you just want financials. A fund is designed for that. There's also index mutual funds. If you want just the S&P 500, you can go get the S&P 500. If you want, the Russell 2000, you could get a mutual fund based on that index. Okay, fund of funds. This is where, let's say you have a bunch of mutual funds. You have a stock mutual fund, you have a bond mutual fund, you have a tax-free mutual fund, and then another fund comes in and buys each one of those, so it's an entire diversified portfolio. That's called a fund of funds. They don't have individual investments. They invest in a bunch of different funds, and you have like 5,000 different positions. Super diversified. Okay? Commodity mutual funds, if you want to like invest in gold, I would not recommend buying hard gold, and we could talk about that. But there are commodity funds that track the price of the commodity, whether that be silver, oil, whatever it is, pig bellies. You could get a mutual fund that follows commodities. Inverse funds. These are interesting. Inverse funds operate the opposite of whatever you're trying to do. So let's say you think the S&P 500 is going to crash. Well, go get the inverse fund of the S&P 500. And when it crashes, you're going to make a bunch of money. What some people do is they'll buy, let's say, $1,000 in the S&P 500, and then they'll buy like $200 or $100. They have a ratio of the inverse fund. So either way, they're going to be kind of making money. They're kind of straddling the S&P 500. Risk, you have your low risk, medium risk, high risk. We're going to go into those and how to show which one of those that you're going to go into and how to measure risk versus possible reward. All right, I can't see the chat, so hopefully there's no questions in there. I guess I could go pop over there. All right, let's talk about ETFs. ETFs are what's called exchange traded funds. These are like mutual funds, except you can buy them and sell them on the stock market. Okay? Mutual funds are priced at the end of the day. You can't see the price fluctuation of a mutual fund. At the end of the day, let's say at like 6 o'clock or something, they will go out and they say, okay, what's our debt? What bills do we have to pay? How many people sold out of our fund? And here's the value of all of our assets at the end of the day, and then here's the corresponding share price. Okay? ETFs are not like that. That's a mutual fund. ETFs are a bunch of investments like stocks, Apple, whatever, Tesla, and it tracks the price of everything in that portfolio, and then that moves on the stock market, and you can buy it and sell it just like that, just like a stock. So instead of buying one stock, you could buy all these stocks and trade all of them at once. So if you think, the financial sector is going to crumble, you can, sell short the ETF and make money on that. So I like ETFs because they're not typically actively managed, which means there's no manager saying, okay, buy this, okay, buy that, okay, sell this, sell that. They're just tracking the price of all these stocks, extremely cheap. It's like 1/2 of 1%. It's like 0.05%. A lot of them charge you. Whereas a mutual fund will be like 0.75%, so almost 1%. ETFs, like I said, passively managed. They're going to have lower costs because they're passively managed. No investment minimums on these. you just buy the share, whatever the share is trading at. If the share is trading at $9, then you get it for $9. If there's no number of shares that you have to purchase. Um, let's see. Yeah, higher costs on the mutual fund side. There are investment minimums on some mutual funds, but if you're with the right brokerage firm, the mutual fund will pay the brokerage firm to list their mutual fund, and the brokerage firm will say, okay, charge. You can't charge our customers, exorbitant fees. You can't have investment minimums. So they'll negotiate. So when you go into your mutual fund screener, you'll see American funds, you'll see the T Rowe price. What they're paying for is to get their name listed on that screener. Otherwise, you'd have to go to T Rowe price and actually buy their mutual fund. But no, they just pay the brokerage firm to list it on their tools, and that's another way the brokerage firm makes money and is able to give you all that research for free. Okay? Sometimes there's tax implications on the mutual funds because people are selling. Let's say the market's starting to crash, or this mutual fund's starting to crash, and it's possible where the mutual fund could lose like a quarter of its assets in one day. What they have to do is sell out of their stock to cover those withdrawals, and sometimes that creates a tax implication where even though the mutual fund's declining, they have to sell their Apple stock that they bought in 1983 that appreciated 200%. And they'll sell that to fulfill the withdrawal. And not only does your mutual fund go down, you now have a tax bill for the trades made inside the mutual fund. That was a huge thing in 2008. I got 10,000 calls. Hey, my money is half gone and I still owe X amount in taxes, and I would have to explain this to them just like I did. Well, a little nicer, I guess. All right. Let's take a look at some individual. This is inverse fund. See how it's short the S&P 500? So when the S&P 500 is doing good, no, sorry, the red is the fund and black is the S&P 500. So when the market crashed in 09, this fund was way up here. And then when the market started to recover, then the fund went down. So this is just an example of an inverse fund and how it's pinned to the price of whatever it's following. Okay, this is the opposite pinning. It's moving in the other direction. And the way they do that is through internal derivatives inside of the fund, where you don't have to actually buy the derivatives, you just buy the fund, they do all the fancy stuff. Okay, that's an inverse fund for my bears out there. They also have what's called leverage funds. So this is Vanguard European market. This is the index for the European market. It only made like 7%. This is a 3x 3x ETF, exchange traded fund. So it makes 3 times the upside. And they try and minimize the downside, but you could see here this index went down by like 2%, and then the actual fund went down by like 10. So it magnifies the losses, but it also magnifies the gains. These are very niche. These are for people that have an idea that they want to execute on, but they maybe don't know how, or maybe don't have the time to have a fully diversified portfolio. Believe it or not, this is diversified. It just has all the investments in it, all the stocks in it, and the derivatives, which makes it a 3x. Okay. All right. Yeah. So these are a little more of the exotic ones. REITs. This is how REITs work. Investors put in money. The REIT or whoever's managing the REIT goes and buys the assets. They get income, and then they pay out that in the form of distributions to the shareholders. Okay, they are the ones that run them. They own them, and they're responsible for keeping up with the properties and everything that has to do with the properties. So you do not have to. What's good about these is they generate income and a little bit of capital appreciation, but mostly income. Because you would have to sell the real estate in order to get the appreciation from the real estate. That happens sometimes in the fund, and they'll like distribute. We sold a multi-million-dollar building to another REIT or whatever, or to J.P. Morgan Chase. It appreciated by 1.2 million. We're going to divide that up, send it out to our shareholders. That is possible. Most of the return on these are going to be in income. These can be publicly traded like ETFs. They are very liquid, but again, you don't have the. It's not like they're investing in one or two houses or 10 houses. I'm talking about huge Amazon data centers. They own, let's say, 10 data centers. They own 14 hospitals, or they own, there's different ones. There's ones that only will only own telecom buildings, because telecom buildings have all these wires going, through the middle of the building. They're specialized buildings. They're never going to move, right? And so that's what they invest in, because that's what they like. We're going to go over some individual REITs. Let's see. There's are some that are privately held. These are kind of tricky. This is when somebody's super rich says, I'm going to start my own REIT and I need investors. Those, you have to be a special kind of investor in order to invest in those. I will cover that on the next class. Again, apartment buildings, cell towers, data centers, hotels is a good one. Though hotels are very on the risky side, which means they're going to return more, because hotels are very seasonal. It depends on what's going on. If you have a Taylor Swift concert that comes to town and there's a bunch of hotels sold out, that's where you're going to get those income from. Medical facilities, offices. Another big one is like strip malls or malls in general, warehouses as well. So these will own those, operate them, and then give you the liquid, or give you the rent in liquid cash. Okay? So there's some very specific rules that they have to go by, and this is why there's high payouts. They have to do 90% of their taxable income has to go back to their shareholders through dividends. Dividends are taxed at a lower rate. This makes it very good for income, because dividends are taxed at a lower rate than taxable income. Okay, so they have to get 75% of their gross income from rent or interest on their mortgages or real estate sales. This means that they can't just have everything in cash. It has to be invested. Okay, they can have some in cash, but they have to continually go buy properties as people buy shares, as people invest in them. They can't just hold on to the money. They have to keep on keeping on to keep their 90% numbers up. All right, now we're going to go through a couple of the types of. I'm not going to spend a lot of time on these. You'll recognize a lot of them. Retail banks, obviously. You got brokerage firm, investment banks, mutual fund companies, investment advisory firms. They all do something different. Investment banks invest money on behalf of big pensions, or invest the bank's money for a return. You may see J.P. Morgan made $100 million on just their advisors or their brokers using their money to invest. Okay, that's what an investment bank does. A brokerage firm is retail, like us. So they'll say, okay, we got 100 million in new assets because we bought E-Trade, and we have all their customers now. And then they trade on their brokerage firm. Um, Investment advisory firm. This is can be part of a brokerage firm. This is where they can give advice as well. A brokerage firm typically isn't supposed to give you advice. They say, you want Apple? Here's Apple. Okay? An investment advisor firm can go in and say, okay, I think Apple's a good investment, X, Y, and Z. We should buy 200 shares. Okay? Investment firm and a brokerage firm are a lot of times combined. And if you have an account with E-Trade or Fidelity or someone like that, there's a spot where you can say talk to a financial advisor, and that means they have an advisory firm. It takes a different license to get it to be able to give advice. Okay. Insurance companies, we all know what insurance companies are, like Allstate and stuff like that. These are typically very different from banks. They usually don't associate with banks or investment firms or brokerage firms or anything like that. They're usually their own entity because they have so many regulations. Mutual fund companies are also typically not in the investment world because they manage the actual assets. They're the ones actually buying all the stock inside their little mutual funds. So this will be like T. Rowe Price. Prudential has mutual funds. There are some brokerage advisory firms, investment banks that have their own funds. Like JP Morgan, you could go in and you could actually buy JP Morgan funds. And that's because they're like all five of these in one. Hedge fund, family office, and private placements. I just want to mention this. There is a caveat for managing your family's money. Okay? These are called family offices. These are kind of in the line as hedge funds because they don't have very much regulation at all. So you can manage your family's money, and there's really not a lot of oversights. Some people, when I was working at Merrill Lynch, you'd have this 19-year-old kid come in, freshly licensed, doesn't know anything. He's got $180 million under his belt, and we're like, how? Because grandma sent him to college. Grandma put him at Merrill Lynch to manage her family's fortune, is what happened. Like I said, very little oversight on those. Okay. Let's see. So yeah, all five of these. Oh, where'd it go? So all five of these, typically now after 2008, are all in one. Prior to 2008, you had them all over the place. Like Bear Stearns was famously an investment bank, and they just went under. So what ended up happening was all these investment banks and these advisory firms and these brokerage firms and these mutual fund well, not so much mutual fund companies, all the other ones ran to be a bank, to register as a bank so they can get all the protections that is afforded to a bank. Some sleazy stuff happened in 2008, but let's move on. How are we doing on time? Okay, looks good. All right. Hopefully you guys open an account based off last class. Hopefully you figured out your risk tolerance a little bit, like what kind of risk you're willing to take. I gave you that questionnaire. You could do that. You could find your own questionnaires. When you open the account, sometimes they'll have a questionnaire as well. So you want to know what your risk tolerance is. Okay? You don't want to invest in something and then it goes down 10% and now you're sick to your stomach and you think the world is going to end. Okay? There was famously a kid that started trading options, derivatives, and I want to say he was a junior maybe. Correct me if I'm wrong. He was a junior. He had a protected trade, but they settle at different times, so one sold before the other. They were linked together, and his balance showed negative 700,000. He committed suicide And then because he thought his family was going to have to pay 700,000, and then the other leg of the other derivative came in, and that was worth 700,000. So he actually broke even. But since he didn't wait to see the full transaction through, he thought he was in the whole 700,000. You do not want that to happen to you. You want to know your risk tolerance. Okay. Um, let's see. Hopefully you chose whether you want mutual funds or ETFs. And well, we could do that today also. And what I want to do is put in some initial trades. I'll show you how to do that. Show you how to use the tools. Uh, you want to set up a reoccurring deposit. And hopefully you guys have done that. Keep you very disciplined. As I talked about last time, compound interest is not based off of a lump sum. You will get compound interest, but it's going to be very low. You want to take advantage of dollar cost averaging. You want to set up that reoccurring deposit. You want to set up that reoccurring investment. Auto invest, or like me, I just have everything go to cash. Like all my dividends or everything, or my deposits all be in cash. And then once a month, twice a month, I'll go in and I'll actually do my manual trading, and that's enjoyable for me. So whatever's good for you, like I said, have tricks to trick yourself into doing the right things, right? Just like meal prepping, right? You kind of tricked yourself into eating healthy, okay? Do the same thing. Then finally, we're going to talk about rebalancing. Rebalancing is extremely important over time, and we're going to get into that as well. Let's see. All right. Oh, this is rebalancing. All right, let's go into the tools. I'm going to take a second to log in. Let me get off this. Show everybody my emails. I'm going to log into the brokerage firm that I use, and we're going to look at some tools. All right. I'm going to jump up and I'm going to check the chat and see if there's any questions. I'm going to jump. That's a transcript. All right, no questions. Okay, here's Charles Schwab. If I go to accounts, it'll show all my accounts. I am on the research tab. If you go to the research tab, every brokerage firm should have a research tab. Okay, it will show you all the markets: U.S., Europe, Asia, and then we're in U.S. It shows the Dow Jones Industrial Average, Nasdaq, S&P 500, the Russell, and what they're doing today. It also has these market reports. Okay, the CFRA morning brief. This tells you what to look for in the market today. If you want to, do some trades based on what's going on in the world, these guys are going to tell you, hey, this is what the economy is doing. Hey, this is what the housing market's doing. We're waiting on, unemployment numbers. Whatever's going on today in the markets that may fluctuate the markets are going to be in these reports. Okay, so these are all the CFRA reports. When you start looking at reports, you're going to start gravitating towards some of the reports and other reports you're not going to like. For instance, I rag on cryptocurrency all the time, and I've a video on it. But some people obviously don't agree. They think it's the future of the future of the future, whatever. If an analyst is like super anti-crypto and you are pro-crypto, probably not an analyst you want to follow. Right? Morningstar, I figured out, is very growth-oriented. I like a little more dividends. I like a little more value. So I don't like Morningstar. They will overemphasize technology companies, growth stocks, stuff like that, and that's just my personal experience. Their 5-star ratings are all companies that I think are overvalued, stuff like that. Okay, Argus, I believe Argus is like quantitative. They look at numbers instead of like fundamentals. Um, and then you have this Charles Schwab one, of course. Then you have all the news, what's going on. The big stock that's moving is GM today. So if you just, here's all the sectors, positive sectors, negative sectors. So this is just, hey, what's the market doing today? It's a good page to like bookmark. Here's some dividends that are going to be paying out soon. Earnings reports that are coming. There's 80 companies. Downgrades and upgrades. So the analysts will say, this stock's is we see potential in the short term for this stock. We're giving it an upgrade. Or this stock just announced that they're closing some plant, and so we're going to downgrade them, which means they're not going to have the future prospects that we thought they were going to have. So, for instance, Morgan Stanley, Centerpoint Energy, CMP. I think it's a decent stock. Morgan Stanley says they downgraded them from $37 a share to $34 a share, meaning that they think they're going to underperform in the future. I could go in and I could read why. I don't own Centerpoint right now. All right, what you want to, well, let me put in a trade real quick. Show you guys how to do a trade. So, when you click trade, and every brokerage firm should have a trade. You could do tickets, you could do mutual funds, you could do small slices of stocks. And then here you can see your order status, open, what's open and hasn't filled, futures. So let's go in my all-in-one ticket. And all of them basically are the same. So they're all going to have a symbol portion. They're all going to say, ask you what kind of investment it is. This one has option investments on it. So you could do stock, mutual fund, call put options, and then these option strategies. Let's say I just want to do a stock or ETF. Okay, got to put in a symbol. Let's see. OMA. Is that it? OMA. I think it's OMA. Okay. OMA, I believe, is a Berkshire Hathaway. I believe it's a Berkshire Hathaway ETF that just came out. I bought one share the other day just to see what it's all about. Here you put buy or sell. Say I want to buy. Calculator here. If you want to invest I think my recording messed up. If you want to put in like a specific amount, let's say 500, and apply, running pretty slow. This will say for $10.53 or for $19.53 a share, you could get 256 shares, and that will come out to 5,000. Did I put 5,000 or 500? I think I put 5,000. All right, and then let's say I want to do, let's say 2 shares. That comes out to $39. So let's say my recurring investment or my recurring deposit is only $40. This will satisfy that. Here is the options for when to put in the stock. This is during the day. This is why when market is open. This is 9:30, 4:30? No, 9 to 4. I don't know. I forgot. I stopped day trading like 4 years ago. Okay. This is a day trade. This is during open hours. Okay. I would 100% recommend that if you're doing ETFs, if you're doing something where the price fluctuates during market hours, that you put it in for the day, because what's going to end up happening is, let's say something is reported after hours, like earnings or some CEO was fired or whatever. This can move crazy overnight, and you don't have access to those. Only big businesses have access to extended hour training, or for the most part, extended hour trading. So you can basically only trade during the day. These good till canceled. This is, let's say I want to buy Nvidia for $100. I have no idea when Nvidia is going to hit $100. No idea. So what I do is I put in good till canceled, and let's say I want to get this particular stock at 1950. Come on, 1950. Okay, it's not going to 1950. Oh, there it went. So yeah, this is good till canceled. It keeps going down. My computer's probably freezing up. All right. So I can put out as far as I want or as close as I want. This is set at January 16th of 2026. Now, if any time between now and this date it hits the 1946 during trading hours, this order will go. This order will buy. Okay? That's what a limit means. A limit order means you want this exact price or better. I like to use limit orders because I know exactly what I'm spending. If you put market order, you're going to get whatever the current market price is for those two shares. So you see the price went away. There's no price. I'm not comfortable with that, right? I want to know my price going in. If I want to pay, a little bit over just to get it in, then I'm going to do that. I'll put in an order for 1960. And if it's trading at 1953 right now, then I'll get it for 1953. But I don't want to spend over 1960 on this. Okay? And that's what a limit order does for you. I could go through all the other orders, but these are not, I don't see a lot of people using, usually typically limit orders or market orders. This carrot's not working. All right. Let me review order. There's always going to be a review button. It's going to tell you what you're trying to do. Come on. This is running very slow. Got too much going on. Come on. All right. Here is everything. I want to buy 2 Omaha at 1951. See that? Look at that. Industry fee, nothing. Commission, nothing. All of it's going to go towards my investment. Okay? It's currently trading at 1953. I want it in 1951. If I place this order, it's probably not going to trigger right away. Place the order. Now they have my order. Here's my order number. It's sitting there waiting for my price to come. If I click on the order number, or if I go to open trades, it'll be sitting right there. See, it's open. Oh yeah, I bought one in 1947 a couple days ago. 721 yesterday. Okay, so I got this limited order out there for 2 more shares. 1951. It's currently between 1951 and 1953. These guys are haggling back and forth. Whenever it gets to 1951, this will trigger and it'll say filled. Okay? Or I can click on it and I can modify it if I want to. I can cancel it, I can change it. So if I hit change and I say, you know what? I'm good with 1953. Let me make this trigger. There you did it, and now it's instantly filled. See that? Filled. Buy. Okay, that's how you do a trade. You could do this with mutual funds. You're not going to see the price fluctuating on mutual funds, but you can do it with mutual funds, and you could do it with stocks and bonds, and you could do it with ETFs. You could also do it with options. They're all very similar in terms of putting in a trade. Okay, let's go back to research. Let's see, you could research stocks, ETFs, mutual funds, options, bonds, fixed income, money markets. Let's go to mutual funds. Okay, here's a mutual fund screener. Find mutual funds, compare mutual funds to ETFs, compare mutual funds to other mutual funds. Here's the list of what mutual funds Charles Schwab likes, and then here are actual Schwab funds. I do own a couple Schwab funds. They have a lot of them have very good income funds. Then here's what I was talking about last class is your portfolio builder. This is what your financial advisor is for. Okay? Their main job is to, one, build your portfolio based on your risk analysis, like the form I gave you last time, your risk perspective, and then create a portfolio off of that. And then find the mutual funds for each sector, and I'll show you in a second. It's not that hard to be a financial advisor. Okay? So, first question they want, mutual funds with taxable bonds. This is, do you want bonds and stocks together in your mix? Do you want those bonds to be taxable? Taxable bonds typically make higher income because there's a tax portion attached to it. So you'll get a 1099 for all the interest for that year. This one says mutual funds with municipal bonds. Municipal bonds are like states and hospitals, nonprofits. Theirs are non-taxable, so you'll get a break on federal taxes. The returns on these are pretty low because they factor in the highest tax bracket. So for instance, municipal bond could be 4%, then a taxable bond with the same risk profile may be 5%. And that 1% is the difference between the tax you're going to pay on. Okay. I always go with taxable bonds unless you have a specific situation. I inherited $50 million. Okay, we may want to go with municipal bonds. Or you can build your portfolio with exchange traded funds. These are, like I said, managed by people. Exchange traded funds aren't managed by people. They're just a basket of stocks just moving with the stock prices. Let's go mutual funds with taxable bonds. This is going to be your typical portfolio. And remember when I said you had the risk analysis? It is asking you what is your risk profile. It's not the full one. It's just a little mini one. Okay? I want current income, stability, and capital preservation. This is going to be for my retirees or somebody who's very, very risk averse. They don't want their money moving at all. We talked about goals last time. Very hard to reach your goal. If you don't have the money that you already want, this is going to be hard to reach your goal. Okay? If you have all the money that you're ever going to want, this is probably where you're going to want to preserve that and use it for income or pass it on to beneficiaries. Okay? It goes more risky as you move to the right. You can see down here, conservative, moderately conservative, moderately aggressive, and aggressive. And this is all based on the questionnaire. Okay? You can find those questionnaires everywhere. I'm concerned with growth and value and can tolerate risk but less than the overall market. So S&P 500 can move 20% in a year. Okay? If you don't want to see, if your goal cannot withstand 20% fluctuations, you may want to pare it down. This may be more of like a retirement portfolio when you're young. Growth means stocks that are oriented towards growth. They want to grow as quickly as possible. This is going to be your Teslas. This is going to be your Apples, Amazons, stuff like that. Value is going to be underpriced stocks. So the value you think the stock is more than the current share price. And when the share price corrects to where the value of the stock is, then there's where your growth comes from, or your return comes from. Whereas growth, it's relatively priced well, and you're looking for it to grow. Tesla, let's say they come out with robo taxis, that's a that's a major growth catalyst that's going to push the stock up. Okay, value would be more like, I would say, Berkshire Hathaway. They're carrying a lot of cash. They may do some investments in the future. They're probably underpriced for what the stock is. Not a very not a very aggressive stock, not a very fancy stock. So that may be a value play. Okay, but this is what the advisor is supposed to do. Okay, so I picked one moderately aggressive. It came out immediately with the proper allocation for moderately aggressive. You can probably expect to get a 10% return annually. The worst year, negative 29. Best year, plus 24. Now you could go in and look at these. The worst year is negative 36, plus 40. Notice the average annual return is plus 10. So these two are very close to each other. It's a time horizon. This is more towards a longer time horizon, high risk level. This one has a shorter, and then this is also high risk level. But you can see what the different allocations is. This is 45% large cap, 15 small cap, which is little companies, international companies, fixed income, which are bonds, and then cash. It's going to have 5% cash. All right, moderate portfolio, still 35%, 10%, 15, and then 35% income. Contrast that, the aggressive has zero income, fixed income. Conservative has 50% fixed income, a lot of cash because they assume you're going to be withdrawing for income. 7%, I don't know if you're going to get that off of 50% fixed income and 30% cash, but it's what it says. Worst year, negative 9, best year, 23. All right, so once you pick your asset allocation, okay, based off your risk profile, again, this is exactly what financial advisors do. They sit down, give you the risk profile, go into their system, pull this up, say, okay, I'm going to put you in 45% stocks, 15% small, whatever, because I'm brilliant and that's what I want to do, right? No, he's got this same software, okay? Go to continue. What investment, or how much is your minimum investment do you want to put in? Now remember, for your initial portfolio, it has to be diversified. That's what these asset allocations are for, to get you a diversified portfolio so it fluctuates. You know, we looked at portfolios taking advantage of the highs and the lows of the different asset classes. That's what this is going to attempt to do. You can't have a diversified portfolio with 20 bucks. You just can't. It's recommending 5,000, which is, a good start. If you set up reoccurring deposits, I assure you, you'll get to 5,000 pretty quick. Say 5,000. View results. All right. Says I want mutual funds with taxable bonds. You could change this. I want aggressive risk. You could change this with these drop downs. You want to do 5,000. That's what you want to do. Okay. Now, what it's going to do is it's going to say, okay, let's choose our large cap fund. Remember, we're doing 35, I think, in large cap. So it will give you 5 of their best mutual funds. Okay, you can see this is on their select list. This is one of their special no load, no fees lists. Okay, this is going to have probably pretty low expense ratios, pretty this these are basically the same. Um, but see how it says Schwab 500 index right here, and this very low expense ratio. This is probably not actively managed. Okay, it's just probably following the index fund, the S&P 500. Okay, this one is probably the most actively managed. That's because it has the highest gross ratio. Okay, so you could click on one of these and see what it does. So let's click on, let's see, T. Rowe Price. Okay, you can see what it's done in the past year. You go all the way back to 3 years. You go all the way back to 10 years. Okay, there's the expense ratio again. You could pop out the chart. Over the last 52 weeks, it's gone down to under $50 a share, and it's gone over $62 a share. It's currently at one of the highs. That tells you where the market's at. You could buy and sell it right off the bat, or you go through this system. Let's say you want this one. Select that one. Now you got your allocation for your large cap, just like that. Okay, go down. Now let's do the international funds. Again, it gives you 5 here. Here's another index, 0.06. These are all different funds. You could go research them, and I'll go research them in a second. Say I select this one. ESG just means it's good for the environment, or it has diversity in its management or something. So this is like its woke score. If you want to do that, if you want to base your criteria on that. Did I skip one? Yeah, I did. Let's select that one. See how it's investing the exact amount based off the percentage. 2250, 750. This one's gonna be 1,000. Then my fixed income fund, it gives me 5 fixed income funds. Let's just pick one. 750 in there, and now I have 4,750 gonna be invested in based off these allocations. 250 is gonna stay in cash because that's what it said my cash allocation is gonna be. This is my cash right here, 5%. So that represents 5% of $5,000. So that's gonna just stay in the account, just for me to do whatever with. And if I put in if I trade this, it will put all these trades on a ticket and do an order at the end of the day. Okay. So let's look at one of these. Let's see what this is all about. The Pioneer, or the Victory Pioneer Bond Fund. Let's look at it. All right. So you got the share price, gross ratio again. This pays a distribution of 5.14. That's its interest that it's paying out. That could be quarterly, that could be monthly. Here's where Morningstar rates it, 4 stars, overall rating, and then on the different periods of time. Looks like it's been around for a while. Let's say of 480 funds, it's a 4-star rating out of 480 funds. Okay, historic return is above average. Risk is also above average. What that means is based off of the benchmark. So remember we talked about benchmarks. This is the benchmark of this is probably Barclays bond index. So it is outperformed the bond index on the high side, but also on the low side. So it's a little more risk for a little more return. Okay. Here's your style box. Credit quality. So these, just like a car note, just like you are based on your credit is your interest rate, so are companies. High risk companies get charged a higher interest rate, pay out a higher interest rate. This credit quality is mid. Okay. Interest rate sensitivity. This is the Fed changing the interest rates, going up or down. This is also mid, so it's right in the middle of both of those. Here's all the fees. Very nice. No fees. It says it's closed. Why would it give you an option if it's closed? This does go into the automatic investment plan. So if you wanted to set up an automatic investment plan in this fund, you could do that. Here are all the minimum investments. Very low on all three accounts. Okay. Here is your charts from $10,000. This is how $10,000 moves. If it were all in this fund, remember we only have what, like 1,000 in this fund? Yep. All right. This follows the Bloomberg U.S. aggregate bond. Okay. Here is the fund. It's going to be the dark line, and the index or the benchmark is going to be the orange line. So you can see right here it had like a hiccup. I don't know what happened there, but it usually outperforms its benchmark. Probably why it recommended it to you. Okay. I'm going to get into these in the next class, but if you look, I'm going to cover these two down here. Upside capture. This is saying when the benchmark is going up, how much of that upside does this fund take advantage of? 107. So when the benchmark goes up 100%, then this will go up 107%. Or it gets 107% of the upside of the bond aggregate. Okay. Downside capture, it only takes 98.89 of the downside. So when the benchmark loses 100%, these are just numbers, it's not losing 100%. When the benchmark loses 100%, this fund only loses 98. So it gives you more upside and limits the downside to a degree. That's why you pay somebody to manage the fund. That's where active management comes in. This is because of the manager. Okay. Total assets, 4.9 billion. Total number of holdings, 1,900 holdings. Pretty good. This guy's been around since 98. Inception date was 2001. So this will have a lot of analysis behind it. This will have a lot of charting behind it. If you have a fund that's very small, a couple hundred million or even less, manager tenures low, inception date's low, this is when it started, not going to have a lot of data on it, so that's going to automatically push the risk a little higher because you don't have that data to see what's their track record, how do they operate, versus their benchmark, and stuff like that. All right, let's look at, is this a stock fund? Let's take a look. Okay, income, growth in income, Invesco. So you can see that the share price is here. Distribution is only 1.1%, and that because it's growth and then income. Year-to-date return is 7.14. That's the growth portion. Distribution, that's what's paid out. That's the income portion. Here are the Morningstar ratings. Over the 10-year, it looks like it was pretty rough. But you can see it has a lot more funds in this category. Stock fund, it has a lot more funds to review. So this got four stars out of almost 1,100 funds over the 3-year period. Over the 10-year, not so much. Again, above high returns, above high risk based on the benchmark. This is going to show you how big the companies are that it invests in, whether they're growth, a mix of both, or straight value. This is 33% value, large cap. It has other mixes, has mid cap, which is middle-sized companies, and then it doesn't have very many small caps at all. These are the sectors that it's invested in, overweight financials. Info technologies, industrials, and if you click on this, it will show you the individuals. Machinery, so it's very well diversified. Has a little bit of real estate in it, has some utilities in it. Um, these are similar funds and similar ratings. So it looks like maybe the T. Rowe Price may be better than this based on the analysts. Again, this one's gonna have a front load. They didn't. I guess they didn't negotiate with Schwab for a no load fund. They're gonna charge you 5.5% right off the bat to invest in this fund, and then every subsequent investment you're gonna pay that load. No transaction fees, and then no minimum investments. Upside capture, 88%. Downside capture, 104%. So it captures more of the downside than the benchmark, but gives you less upside than the benchmark. Probably not a good idea. I mean, here is the index, the S&P 500. S&P 500 is orange. This fund is here. This is probably the lag from the income, I'm guessing. If it was pure growth, it may be closer to that. Since it has an income portion, then it probably underperformed. Little high in the expense ratio, not bad though. Only 79 total holdings. You remember the bond fund had like 1900 or something. So yeah, you want to compare these or just go by the recommendations. There's another one, large cap. Go through all of it again. Again, overweight financials. This looks very close to the other one. No front load. Low initial investments. Very close or closer to the S&P 500. Still takes a lot of the downside, and that's probably just recently. Let's see. T. Rowe Price, large cap value. So this one's totally value. It says 3.15 billion. Total holdings 84. Pretty close to the other one. He's been around since 2000. All right. So this is how you look at mutual funds. This is how you analyze them. This is how you screen for them. If you look at, let's go down to research tools. Am I doing it on time? I guess I'm okay. Research tools, mutual funds, mutual fund screener. You could create your own list of what you want to look at, and you could do pretty much anything here. If you like funds that are good for the environment, you can do ESG funds. But pretty much any screen that you want to put on there, you can. Let's look at the predefined screens. Let's say we want a sector fund. This is purely healthcare. This is purely financials. It's purely communications. And you can look at these individually and see which one you want. These are all no loads. Open to new investors. Here's the star ratings. Here's the expense ratios. If you think something's going to go on with the healthcare industry, and you want to do that play, here it is. One specifically invested in healthcare. So Schwab Healthcare. Let's take a look at it. All right. Here's all the ratings. Here's the price, expense ratios, distribution, not very much. 99.9% healthcare. Pharmaceuticals, biotech, healthcare providers. So this is a purely healthcare play. Here's the size of the companies. A little bit of small caps, mostly big companies. Here's a growth of 10,000, but this is compared to S&P 500. But you're only in one very small sector of the S&P 500, so this isn't a very good benchmark. This is probably a better benchmark because this is the healthcare industry as a whole. This one is just this fund. So it matches very closely to the healthcare index, which is probably pretty good. Okay. Here's the upside and downside. I would say this may be based off the S&P 500. It's kind of hard to evaluate sector funds just because of this. 79 Holdings, Pure Healthcare, around since 2000. Manager has been there since 2013. All right. Let's look at a REIT. Let's say Doc. Let's look at Doc. This is a REIT that goes only for doctor's offices. So here it says here, Healthpeak Properties, fully integrated real estate investment trust in the S&P 500. Healthpeak owns, operates, and develops high-quality real estate focused on healthcare. Okay, so this is basically owning healthcare real estate. See where it says bid and ask? This is exchange traded fund. This is moving with the stock market right now. Okay. Here's a 52-week high, 52-week low. It's trading a little bit on the low side. It was 23.26 at one point. Morningstar has it a 5-star rating for its area for a healthcare REIT. 4-star. Argus does stocks, not mutual funds, so they rated a buy. Here's all the news on it. Because it's a stock or ETF, then it's going to have its own news feed. It's going to look a little bit different than mutual funds. As you can see, there's different criteria that these are based off of. Here's the shares outstanding, shares held by institutions. These are your big companies. 95% of this fund is owned by huge companies. This is mostly mid-cap, $12 billion. This is going to show a short interest. That you want to look at that in regular stocks, not ETFs. Here's the distribution: 6.63% annual yield. Dividend rate is $1.22. So whatever the share price is, it's going to pay out $1.22. So that's why the 52-week fluctuation is important. Because if it's trading at 16, that $1.22 is going to represent a different percentage based off that share price. It's currently trading at 18.9. So this 1.22 annual dividend represents 6.63. As the share price moves, this will also move. This will stay the same. Because this is per share, not based off the share price. Okay. It's going to estimate your dividends. It's going to tell you when the dividends were announced, when they're going to pay off. Next earnings announcement is actually in a couple days. It's going to pay out in a couple days. Here's the history. Here's of some of what it owns. All the stock implications here, earnings per share. I'm going to cover this in the next course. Next course is going to be options and stocks. That's going to be advanced. Here are some of their competitors, their market cap, how big they are, their last price, their annual dividend. So see how this one has a higher annual dividend. Let's see, Schwab rates it a D, probably a little more on the risky side, has a little less assets. So yeah, this is an ETF that you could trade right now, and you could sell it right now if you wanted to. Mutual fund, if I put in a order for the mutual fund, it wouldn't fill till the next day, and then if I put in to sell it tomorrow, it wouldn't sell till the close of business tomorrow. All right. Let's look at Rebalancing. If you guys want to know anything more about the tools, we could have a one-on-one appointment. Um, but it looks like that's all I have time to cover. So I could get rebalancing done. Rebalancing is when you set your asset allocation, just like we did, 35% large cap, 20% initial or international, whatever. This was your allocation. Say this was your allocation. You want to go 60% stocks, 35 bonds, no international. Fine. That's what you came up with. Over time, because the stocks are more aggressive, your portfolio could have grown. Let's say it went from 5,000 to 10,000. You had 60% of 5,000 was in stocks. Let's say stocks are a little more aggressive than bonds and grow more. Now you have a $10,000 portfolio, but 80% of it is stocks because stocks grew, became a larger portion of your asset allocation. Now your portfolio is way more aggressive than what it started at. It's got 20% more stocks in it, way less bonds. It's a larger amount, but it's way more aggressive. So if and you're going to take the hits if you don't want to be that aggressive. This is over time. So if you want to reallocate it back to the original, you're going to have to take some of the stock here, sell it, put it into bonds. Okay? Pretty simple. This is also a good way to capture upside, right? Because these stocks this stock has appreciated. Sell some stock when it's high, reallocate it into bonds. Bonds are safer, and now you've locked in some profits. Okay, so rebalancing is incredibly important because one, it makes sure it messes up your allocation over time, and it gives you an opportunity to look at what's working and what's not, take profits where needed. It's a good tool that we use in the industry, and this is an excuse to get clients back in the office. Hey, we need to reallocate your portfolio. Come on in. Okay. I think I'm running out of time. All right, herd mentality. We're going to cover herd mentality right now. Okay? This is. What did I do? No, I didn't want to do that. I messed up the animations. All right, this is Workhorse. Workhorse was a company that does electric trucks for businesses. Okay? Workhorse. WKRS. This is their chart from 2016 to 2025. It has this huge upswing right here. It went from like $2 to like $10,000 a share. This is based off splits. So what happened here? Well, herd mentality happened here. Twitter happened here. Facebook happened here. This turned into a meme stock. Why? Because the post office announced that they were in the running for a huge government contract to replace all of the mail trucks. When do you think it was announced? Probably in here somewhere, right? Probably mid 2020. Skyrocketed. Some people took some profits, and you could see it just yo-yoed. And now look where it's at. Turns out they didn't get the contract. Turns out they were in the running, but they didn't have a good chance at it. And you know what? The contract is awarded, but I don't think that it's even been filled yet. So, yeah, that is herd mentality. You want to stay away from herd mentality. And the way you stay away from herd mentality is you look at the value of the stock, you look at the value of the mutual fund, you look at the value, and this is why I have a problem with Bitcoin, because let's say we're looking at GameStop. I want to know what their sales are. I want to know what their revenue is. I want to know some basics about how much cash they have, how much debt they have, and this is what analysts do, and you look at the value of the stock. Okay, if based off all those criteria, it's only a $20 stock, then don't pay over $20 for it. Workhorse had nothing. They didn't even have. I think when they announced the post office, they didn't even have a plant to build their trucks. I think they just had a prototype. Yeah, they had nothing. They had zero value, and they went up to $10,000 a share, which means they were like a $1 trillion company. That is herd mentality. Paying when there's no value there. Paying for an asset that doesn't really exist. Workhorse wasn't an asset. It wasn't a valid company. Okay. Um, let's look at some of the S&P 500, and let's look at some of these events here. You can see it was pretty stagnant. Had some booms here with some of the wars. Here's the Vietnam War, very stagnant. And then we had a huge upswing through the 80s. If I zoom in on this, you'll see more fluctuations, but I'm looking more at the long term. It's why you don't sell, why you don't panic sell. Okay, here's the financial crisis. We thought the world was going to end, and bloop, it's just this little bloop, and then we've been on a bull run since. Now, what is a bull run? What is a bear run? These definitions have meaning, they have definitions, but a lot of people don't use them. They just say, oh, we're in a bull market, which means the market is going up, means there's positive sentiment in the market. Bear markets means there's negative sentiment in the market, and the market's typically going down. You'll have your forever bulls, like Ray Dalio or Michael Burry, where it's all doom and gloom all the time. They think the market's going to crash all the time, right? And maybe 1 out of 5 times they're correct, and that makes them a superstar, okay? But let's look at how often this actually happens. So here are the bull markets, and here are the corresponding bear markets. So if I were to take this chart out the bull markets by percentage, and then chart out the bear markets by percentage, and compared them to each other, this is what it would look like. You have a tiny bear market followed by a huge boom. All these little tiny bear markets followed by booms. Look at the boom from here to here. Massive bear market. What was that? 10-year bear market? If somebody were to miss this bear market or miss this bull market, what do you have? You're not going to have anything by retirement. Okay? Bear market is, again, buying opportunities here. Have conviction in your strategy. Have conviction in your asset allocation. Buy more here, because here's the bounce. We are in another historic bull market from 2008 on. Another historic bull market. We had a little bit of hiccup. This is the pandemic right here. That's how small that was in terms of bear markets. Very short bear market. These opportunities to buy come very quickly and leave very quickly. Okay, you may not capture that from this chart, but definitely when you look at the bear markets versus the bull markets, there's very little opportunity for dollar cost averaging in bear markets. Okay, so if you were to dollar cost average here, $100 will buy you this much. $100 will buy you. You're buying less shares as the shares go up. This may be, you may only get 1 share up here if you're dollar cost averaging. But guess how many shares you'll get down here for that $100? Tons of shares. And then the shares just bounce again. Again here, you buy shares down here, tons of shares for your $100, and now look, it bounced again. Don't panic sell. If you put together a portfolio, if you put together, you know your risk, you know your reward, you know what your goal is, have faith in that goal, and just keep chugging along like you're going to the gym.